Are the BEPS action plans impacted by the pandemic? The increased movement of people in certain countries providing favorable tax regimes to expats. So, yes. And we remember BEPS, what is BEPS? Is the base erosion and profit shifting action plans have been significantly impacted by the COVID-19 pandemic, which was quite heavy. So what we need to understand that is that it increased the global mobility due to that and favorable tax regimes for expats. So these factors all created a new environment, and it created a lot of pressure on international tax enforcement, and it led to shifts. It led to shifts in how countries implement BEPS action measures. So first one, how did the pandemic affect BEPS implementation? So the first one is the COVID-19 pandemic accelerated several tax-related trends, which affected transfer pricing, which has been a big one, and obviously the tax residency rules, and of late, the so-called digital taxation. So the disruptions to transfer pricing, which are BEPS actions 8 to 10, you had supply chain shifts. As an example, I know of certain businesses that decided they're not going to continue operating in certain African jurisdictions because the supply chain was very compromised and they could not ensure that their product got to a certain country, and therefore they decided they need to make changes. Some of them realized that they can't anymore supply out of one of the countries where their group is. They need to bring it from another jurisdiction. So you all of a sudden had a transfer pricing, let's say, risk when they were supplying it internally, but then they decided to move to an external provider. Then you don't have transfer pricing issues anymore. And that then changes how the taxes, or how that jurisdiction taxes the group's income, because you don't have a TP issue anymore, just by means of an example. So then you have government support and state aid. Many MNEs benefited from government aid. Some tax authorities are now scrutinizing whether these should have been allocated at an arm's length. Remember, one of the things that happened during COVID is that you had a problem with relocating to a certain jurisdiction, or certain people had what we called, what was their residency from a place of effective management point of view. So that became a big issue in terms of the PE risks, and that then created a problem because, people became accidental tax residents in foreign countries. So that refers to BEPS Action 6 and 7, which are your remote work and tax residency rules. So one needs to understand how this works. But just back to the transfer pricing guidance, the BEPS response was that they issued a transfer pricing guidance in 2020 on COVID-related adjustments. So they emphasized adjustments for one-time losses or treatment of government subsidiaries and the comparability of COVID-19 period financial data. As one knows, you many times have to go and look in databases, but now all of the data across, let's say, the world was actually impacted, let's say negatively, which made it quite difficult to actually get good comparable data. So that's another reason which needs to be understood. So that was now BEPS actions 8 to 10. Obviously, BEPS actions 6 and 7 has to do with your permanent establishment. And then you have tax authorities who raised concerns about employees working remotely, triggering the permanent establishment risks. So you've got to look at how does this work? And, aren't you creating PEs due to the fact that people could not traverse or move as much as what they used to? Then I mentioned briefly just now the digitalization and BEPS 2.0, the Pillar 1 and Pillar 2, which is now being implemented in many countries. So you have the acceleration of digital business models, which is also quite interesting. So that's quite interesting. I think one needs to understand the business models. We've moved away, over the last 20 or 30 years. You've got a lot more digital business now than what you used to have in the past. We had physical business, and that obviously creates its own challenges. So one needs to understand what countries are doing from a digital tax reform point of view. You then have the OECD response, the BEPS 2.0 framework, which was finalized in 2021. And now it's focusing on Pillar 1, which has to do with reallocating taxing rights to market jurisdictions where large digital companies generate revenues. And we know there's been a lot of tax or court cases around this over the last few years. And then the second one has to do with Pillar 2, which was implementing a 15% global minimum tax to prevent profit shifting in low tax jurisdictions. So these are two very important points, and I think the BEPS 2.0 framework, Pillar 1 and Pillar 2, is going to form a large part of where international tax trends are going, and one needs to keep your eye on that as the laws change and as domestic law changes to come in line with what the OECD is driving international. So that brings us to another important point, which is the increased movement of people and how the BEPS challenges play into that. So you have many people that work and their tax residency might be in one country, but now they become expats and they start moving around in different jurisdictions. So Portugal, as an example, they've got the Portugal's non-habitual resident, the NHR regime, which was abolished in 2024 and it allowed expats to pay 0% tax on foreign income for 10 years. Just an example. Now, as you can see, it's got that emphasis on 0% tax on foreign income for 10 years, which is quite a long period. Then you had the Italy's flat tax for high net worth individuals, a flat 100,000 tax cap for foreign sourced income attracted wealthy individuals. So you bring into that jurisdiction, Italy, you bring a whole lot of high net worth individuals and you cap their foreign income to 100,000 euro. But now you can think how that plays into bringing further income into the country and how it's being kept. So that's another one which is undermining BEPS, as an example. The UAE and Singapore have introduced zero tax or low tax residency programs with digital nomad incentives. Again, so the people can start spending their money there, but then they have very little tax or zero tax. And then Greece, Spain, and Thailand offered golden visas and tax breaks to foreign retirees and remote workers to come and live there. So it's interesting what people have, what the countries have done. But remember, this is not completely in line with BEPS. But, you know, countries, the governments have got difficult things to look at and how to deal with this. Then we've got challenges for BEPS. So the first one is the loss of tax revenues. We've given some examples here, and it's got a lot to do with where wealth is based and where wealth is moved as people move. The other one is the difficult enforcement of CFC rules. You know, countries are struggling to apply the CFC rules when individuals move frequently between tax-friendly jurisdictions. It becomes very difficult because CFC rules are already quite technical. And then you've got what is also one of the BEPS initiatives they wanted to prevent is treaty shopping. And we still, even in today's environment, have a lot of this activity happening where expats strategically relocate to treaty-friendly jurisdictions to reduce their withholding tax on dividends, royalties, and capital gains. So I think there will come a time when most jurisdictions across the globe are going to prevent this from happening. But until then, you've still got these, certain people will look at it as tax planning initiatives. Others will look at this and say it needs to be frowned upon if you look at it from an international tax point of view. So what is the OECD's response to these mobility issues? So they introduced, as we said earlier, the Pillar 2 rules, which is that 15% rule. And that's, to ensure that there's a top up, to ensure that the taxes do not go below a certain level. BEPS Action 5, which focused on ensuring that preferential tax regimes are linked to real economic activity. So you've got that economic activity test, and that's to ensure that if you can't prove that you're doing certain things to prove that you're not just, let's say, use the word the post box entity, you then actually need to prove that you're doing a lot more than just being a post box entity and just using local people in that jurisdiction to do the administration of the company and the compliance. So it's important to look at the active versus passive activity in various jurisdictions, especially the low tax jurisdictions, because they are changing the rules to be more aligned with the active test rather than just being a passive holding company. And then you've got the increased exchange of information under the BEPS actions, where they're making sure that there's an automatic exchange of information to ensure that expats' incomes are tracked thoroughly. So how are certain countries reacting? Let's give some examples. We just now spoke about the UK. So there were reports that said that about 10,800 millionaires left, but the potential government response restricted non-domicile tax rules, which means tightening temporary non-residency rules. That's one way of addressing that. If you go and look at Brazil, which we spoke about earlier as well, Brazil's strict CFC rules and high taxation have led to wealthy Brazilians moving to Portugal and the UAE. And the government is considering stricter tax residency tests to prevent this from happening. Just 2 countries as an example. So that brings us to the future of BEPS in a post-pandemic, highly mobile world. So you've got the stricter enforcement of the BEPS rules, which means that you got to have stronger substance requirements, in other words, the economic activities. You've got exit taxes for individuals, and you've got higher withholding taxes for individuals who are using treaty shopping. Then the other initiative that the BEPS is applying is the global minimum tax, which is Pillar 2, and that was mentioned earlier. Then you have tougher regulations on digital nomads, meaning governments may tighten the tax laws for remote workers to prevent tax residency abuse. And as we know, in today's world, there are many remote workers, so they don't necessarily need to be in a certain jurisdiction to do work for another jurisdiction. And that's why they've got to tighten this. And then you've got to increase data sharing and AI-driven tax audits, which is becoming more and more the flavor of the day. And that is, due to COVID, there's been a lot of mobility and favorable tax regimes for expats who are challenging the BEPS framework. And that's why one needs to go and implement some of these, in certain instances seen as drastic measures. And that's where data is being shared between authorities. And you've got the AI-driven tax audits, because as we know, many jurisdictions have got a form of AI system used for their normal corporate or income tax returns that need to be completed. So this is going to form more and more part of the day-to-day managing and running of companies.